Hello students, I'm so excited to have you back with me today in this video. I am Favor Olarewaju and I remain your class instructor for the introduction to microeconomics as in MICRO. And as usual, we are covering the chapters in the Gregory Mankiw textbook. Either 9th or 10th edition is fine to follow through. I'm all about simplifying complex economic topics and making it as relatable as possible to everyday life, not just for students at the University of Memphis, but students all around the world at large. So before you continue and we get caught up in today's topic, don't forget to like, to subscribe, and to share this video to your friends who might find it useful. So today we're going to be talking about chapter 13, which is on the design of the tax system. So I'm sure even as young people, we have all heard about taxation or be affected by taxation in one way or the other, right? So today we're going to be learning how the tax system works and basically why do we even have tax. So to start off with, government intervention is not always a bad thing. Okay, so as long as it is done as a corrective measure, as opposed to being autocratic and trying to force people, then it's a good thing. So for instance, providing public goods and services like the public parks, the national defense, fire protection, and even anti-poverty measures to make life easier for low-income earners. These are good things that the government does as a corrective measure when there's market inefficiency. So when the government sees that the market system is basically extorting the lower income individuals, then the government steps in to help out. And this is only done when the total benefit, as we talked about in the last chapter, exceeds the total cost of implementing such public goods and services, as well as the common resources that are useful to the society at large. Government intervention is also very helpful when it comes to correcting externality problems, right? So for instance, especially negative externality, when a person's actions or a group of people's actions are having negative effects on the society at large, and the government has to step up and try to remedy that solution. And also even in regulating common resources to avoid free riders, right? And to avoid abuse of free goods and services. So how does the government intervene? Most times, as we mentioned in the last chapter, the government intervenes by taxing, right? So taxation. So again, as long as the taxation is done in moderate manner, then it is going to be beneficial to the society, as long as it's not extreme. And this is because when a tax is imposed on any good and service, as you know, it increases the price. So that increase in price is definitely going to reduce the market quantity that is demanded. So in a case where there is excess production of goods and services, then that would be a good thing to reduce the excess production, right? Now, there is something called tax incidence. And tax incidence simply refers to who bears the burden of the tax. Is it me or you as consumers, or is it the producers? Well, that simply depends on how elastic a product is. So I'm sure if you've watched the previous chapters, on chapters 1 to 6, we have talked about elasticity of demand and supply and all of that, right? So basically, elasticity refers to how responsive individuals are to changes in price, right? So for luxury goods, they tend to be elastic, so people tend to be more responsive. So any slight change in price, people are going to find substitute goods, alternative goods and services to consume, right? So in that case, elastic goods would find that the producers have to bear more of the tax burden, because if they shift more of the tax to the consumers, then the consumers are going to switch to alternative products, and the producers don't want to lose their customer base. On the other hand, when you talk about necessities like water, for instance, like even the house where you live in, or electricity, you can't do without electricity, especially in developed countries, or even medical products like medications for diabetes and other life-threatening ailments, such kind of goods are very necessary. So no matter how much prices increase, consumers are still going to find a way to keep on buying those commodities in order to sustain themselves over time. So in that kind of case, the producers can pass off most of the tax burden to the consumers, knowing that, hey, we don't have a choice, we still have to consume these essential goods and services. So what happens when tax is extreme or not done as a corrective measure? It could lead to a reduction in consumer surplus. So consumer surplus just means how much are you gaining in the market. So for instance, if I'm willing to pay $5 for this marker, and I go to the store and I see for $3, then I'm able to save $2 in my pocket, right? So in that way, I've been able to gain. But if there's a tax on this marker, and then the marker now becomes $5.50, then I'm kind of on the borderline. Do I really want to spend extra than I'm willing to pay to buy this marker? And so in such a way, taxation can lead to reduction in consumer surplus and even drop some people out of the market because they can no longer afford the products because of the higher prices. In the same way, taxation leads to reduced producer surplus. So remember that even though tax burden is shared between the sellers and the buyers, whether the sellers are incurring a greater or lesser amount of tax based on the elasticity and based on how much they are able to pass on to the consumers, the sellers will still have to pay a certain proportion of tax to the government. And in that case, the sellers or producers are made worse off. So they have reduced welfare, less savings. So producer surplus reduces. So now when the loss in consumer surplus and producer surplus exceed how much the government is gaining in the form of tax revenue, then that becomes what is known as a deadweight loss. Now, how has government intervention changed over time? So as far back as 19th century, government intervention or the national revenue was just about 7% out of total income. But now this has grown to about 30% of the total income of a country. So meaning that 30% of the national income comes from government revenue. So that tells you that government is being more involved in economic systems right now as opposed to back in the 19th century. How about in terms of like the proportion of tax, how does it vary across countries? Well, countries in the Europe, for instance, Germany, Canada, Spain, Italy, those countries tend to charge a lot more tax, which has its good and its bad side. But the reason they charge more tax is to be able to have a more efficient public system. So things like public transportation are very, very efficient and common back there. You don't even need to have like a car or your own means of transportation. You just go out and you take a public system, and it's literally every couple of minutes you would see a train or a bus that is going your direction, and very affordable too. Another benefit of the public system that is funded by the higher amount of taxation in Europe is also the health system. So the health system is also more reliable. Remember, we talked about a single taxpayer in the previous chapter, and that simply means that the government foots most of the bills, especially for its citizens. So that is also beneficial, and in some cases too, the food could be healthier than it is in the US. So the US has way lower tax, and it shows because the healthcare system is way more costly for us, and even public transportation is not the most reliable, especially in some cities more than other cities. So now, what are the different types of tax that the government can impose on its people? The first type is known as the personal income tax. So that out of your income or wages, a certain amount is remitted to the government before the money even gets into your bank account, right? So that is known as the personal income tax. And it's not just for company workers. Remember the different types of resources. There's land, there's capital, there's labor, and then there's entrepreneurs. So for the entrepreneurs, they make profits, but on the profit they make, they have to pay tax to the government. Personal income tax. For the capital and land, that they incur interest and dividends which they have to pay to the government. For the workers, the laborers, they get paid wages, and out of that they pay the tax to the government. The second type of tax is known as payroll tax, and this is mostly for social insurance. So in other words, for public uses such as the social security tax or the Medicare tax. And what this means is that whatever tax you pay towards your social security or Medicare, remember that Medicare is for the older and disabled people, and then social security tax is towards retirement, right? So that is a form of savings towards your future, towards your retirement, so that by the time you stop working, you can still afford to get by based on your savings. Now, the personal income tax is usually, in terms of magnitude, the most amount that contributes to the government revenue, followed by the payroll tax, like the likes of social security tax and Medicare tax. Then the next tax, in terms of magnitude, is the third highest tax, is known as like miscellaneous taxes, things like excise taxes. So now, the excise tax is on produced goods. So goods that are manufactured automatically have to pay an amount of tax to the government. Another kind of miscellaneous tax is known as the estate or property tax. So basically, if you have a land, you have a building, you're going to pay tax on that, okay? And then another form of miscellaneous tax is known as custom duties. So custom duties simply refer to things like tariff. So it refers to like tax on international goods or goods that are being imported into a country. So all of that is known as custom duties. And this is the third highest amount that contributes to the government revenue. Now, the fourth highest tax that contributes to government revenue is what we know as sales tax. So sales tax, everybody has to consume. It's a form of consumption tax. So basically, for every time you buy anything from the store, the restaurant, whatever it is, you're going to pay a sales tax, okay? And that sales tax is kind of similar but also different to the value added tax. So value added tax means at different stages of production there's going to be a tax, right? So remember we talked about the excise tax for when a good is manufactured, right? So let's say a good is manufactured and then it moves from intermediate good to a final good. So for instance, oranges, right? The oranges as in fruits, and then from the time it became oranges as in fruits, they pay tax. Those manufacturers pay tax to the government. Now at the next stage of production where it becomes a juice, orange juice for consumers to drink, then that is now value added tax that is also paid on the juice in addition to the sales tax. The fifth kind of tax that contributes the most to national revenue is known as the corporate income tax. So this is based on company profits, right? So strictly for companies, every profit that they earn, they have to pay tax to the government. So these are the 5 different types of tax and how they contribute to national income or revenue. So what is the goal of most policymakers when it comes to taxation or even any form of government policy? The goal is equality and efficiency. But as you know, there's going to always be a trade-off. You cannot be equal and be efficient at the same time. So most likely, if a policy is being efficient, it's going to be less equal. And we're going to see more of that as we take an example. Something else I wanted to illustrate, we talked about sales tax, which is a consumption tax, and we talked about income tax. So which one do you think is better? It's been debated, but possibly sales tax is better because it would help you to spend less on goods and services and help you to save more. But if the income tax was higher, then the net pay you are getting at the end of the month isn't even tangible to even afford the goods and services in the first place, right? So most economists prefer sales tax as opposed to income tax. Now let's move on to example 1. How do you calculate your tax liability? In other words, how do you calculate the tax that you're meant to remit to the government? So let's take two people. Let's say we have Kayla, who earns $49,000, and we have Malik, who earns $39,000, right? And remember that right now in the US and in most countries, there is something we call a progressive tax. So meaning that the higher the income you earn, the higher the tax you pay, right? So for low income earners is about 10%, for higher income earners is about 15%, and the more the income increases is about 22%, right? So now let's calculate how much tax Kayla is going to pay given the fact that she earns $49,000. So 10% of 9,875. So let's say now 9,875 is the max for low income earners to get taxed 10%. So 10% of this amount plus anybody earning above 9,875. So let's say the next income bracket to be 40,125 minus 9,875. Whatever the difference is, 15% of that, and anybody earning as much as the next income bracket, which let's say it's most likely going to be 50 something K, but because Kayla earns 49K, which is less than 50 something K, so then 49K minus 40,125. Okay, so by the time you add this up, you're going to see that Kayla is going to end up paying tax of about $7,477.5. How about Malik? In a similar fashion, Malik is going to pay tax of 10% times $875 plus 15% of the next age bracket, 40. So the next age bracket is meant to be 40,125. But you see that Malik earns 39K, right? So he doesn't reach the maximum of the next income bracket. So basically 39K minus 9,875. And this is going to lead to a total of about 5K, 5356.25 that Malik is going to pay as tax, right? So this is how you calculate your tax liability based on the different percentages, tax percentages for different income brackets. Now, what is average tax? Average tax simply means how much proportion of your income are you giving up for tax, right? Okay, so in this case, average tax for Kayla is going to be $7,477.5 divided by her income, right? So 49,000. So average tax rate is calculated as total tax divided by total income times 100. All right? So by the time you do this calculation, you're going to see that the average tax for Kayla is about 15.3%. So on average, 15.3% out of our income is going for tax. How about for Malik? Malik is going to end up, average tax is going to be 5,356.25 divided by his total income, 39,000. And that is going to give about 13% on average. How about marginal tax? Marginal tax just simply means for each extra dollar you earn, how much of that do you have to pay as tax, right? So how about a situation whereby tax is not calculated based on percentage, but it's calculated based on a fixed amount? So for instance, everybody in the United States has to pay $500 per month for tax. That's going to be unfair to some people, and that's going to be fair. It's going to be unfair for the low income earners, but it's going to be more beneficial to the higher income earners, right? But in that kind of case, if everybody is paying a fixed amount of tax, then the marginal tax will be $0 because everybody is paying the same amount in currency terms. So basically, a lump sum tax is efficient in the sense that the marginal tax is $0. There's going to be no deadweight loss because everybody's paying the same amount of tax in currency terms. So no deadweight loss is efficient. The cost of collecting the tax will probably be the same for everybody. However, it is not equal, right? Tomorrow we talked about equality and efficiency. So even though this is efficient, it is not equal. So which is why most countries would rather implement things like proportional tax, where you are charged a certain percentage based on your income bracket, like we saw in this example, or even progressive tax, where the higher income you earn, the more tax you are charged, right? So in proportional tax, it's like everybody is charged the same percentage, regardless of your income bracket. So again, that can still be seen as unfair, especially for the lower income bracket. So looking at the lump sum tax, charging the same amount of tax could be more beneficial for a married couple because they'll be paying as a single household than for a cohabiting couple that are not actually married but living together. At the same time, the percentage of tax could be better for cohabiting couples that are not living together because they are paying individually in terms of percentage, and then by the time you combine their income together as a married couple, it's actually a higher amount of tax, right? So depending on whether it's a fixed currency, it could be beneficial, fixed currency amount, it could be more beneficial to a married couple, but the percentage tax more beneficial to cohabiting couples. So when you have a fixed tax in currency terms that is more beneficial to married couples, that is known as a marriage subsidy. But when you have a fixed percentage amount that is more beneficial to single cohabiting couples that are living together, then that is an example of a marriage penalty in terms of taxation. And that is that for chapter 13. Thank you so much for watching through till the end. Feel free to like, share, and subscribe. As always, your support means a lot to me. See you in the next chapter.